Welcome, Richard, and thank you for joining us today and giving us the opportunity to talk a little bit about Watkin Jones results for the full year.
Yeah, glad to be here, thank you.
Obviously a great maiden set of results for you to come in on. Obviously you've only been here for 14 days, but perhaps you could pick up a few of the highlights for us.
Definitely, as you say, it's a fantastic set of results. In fact, a record set of results for Watkin Jones. It shows that they're going from strength to strength. Having IPO just 2.5 years ago, look at the journey they've been on since then, and I'm really confident about the untold sort of chapter of the next phase of their growth story. Something which clearly I'm personally very, very wedded to and looking forward to getting into. But the basic headlines are a 20% increase in revenue, 15% increase year on year in profit, and a good 15% increase in the dividend up to 7.6 pence, up a penny on the previous year. So all things across the board are moving extremely well.
Excellent. And the handover period with Mark has gone well?
It's gone really well. In fact, it's gone better than we thought it probably would. The number of sort of factors came together on that one. First is that off this platform of record results really speaks for itself. The business is performing extremely well across the board. The leadership executive team, so outside of myself and Phil Byrom, there are other senior executives within the business who've all been invited to step up, take on more accountability and have more sort of breadth across the business over the last 18 months. And Mark felt very strongly that team, the capability of that team has improved, and they've really taken on that challenge and we're running the business well, looking after the risks of delivery. And then my handover with Mark over the last period, it went really well. So we thought actually as a positive mutual decision, Mark felt that this was a very good time for him to step away from the business. Obviously we wish him well, thank him very much indeed for the hard work he's put in and the family alongside the wider business over the last few decades. And they are a supportive shareholder of the business going forward.
Fantastic. Well, we're all encouraged by that. So if we look into the business then in a little bit more detail, we just start with student, which is obviously the big profit driver in the business at the moment. Happy with progress in that division of the business?
Yeah, student accommodation, as you say, is the engine room of performance for Watkin Jones and has been for the last few years. And in terms of going forward, it remains to be the case. The business is delivering sort of circa 2,500 new bed spaces annually for the next couple of years, and that very much drives the visibility of future revenue and future earnings. And in fact, a large proportion of that pipeline over the next couple of years has been forward sold to institutional investors. So we've locked in a really attractive price, we've locked in a really strong margin. Now the team need to deliver those buildings on site, and that is no mean task, but it's absolutely the core expertise of the business. So I think in terms of the next couple of years, whilst there might be broader volatility experience elsewhere within the UK economy or global economy, Watkin Jones is looking to be set up in a good position.
If we look into a little bit more of the detail then, perhaps, certainly the number of beds delivered in 19 and 20 does trickle down. What are the reasons behind that?
Well, I think the key driver there is it's been about managed growth, and the strategy of the business over the last few years has been about steady, incremental, deliverable managed growth. And what the team have done, quite a conscious decision, was to secure a pipeline predominantly in the southeast of England. The site values there and the end values, the asset values are all higher, and therefore the margin has been maintained, but a margin on a higher value product clearly generates more in terms of pound sterlings coming into the business, and therefore we can still see the revenue growth even though it's on a slightly smaller pipeline. Very confident about the future in terms of being able to deepen our pipeline. There's good land availability which really has opened up following the 2016 referendum, and then some concerns at that stage that the real estate cycle could be quite late. Been a general cooling of activity within the commercial real estate sector within the UK, and that has allowed sort of land to come down in price slightly and generally more availability of that land. So we feel confident whilst Student accommodation sector remains robust and there's record levels of transactions there, record yields experienced across 2018. And the build-to-rent sector, even though it's in its infancy, is growing really well with a record level of transactions last year, levels of around £3 billion of activity, that we should be confident to access that land to put into those two sectors.
You touched on there, you're seeing a greater proportion of the student accommodation in the southeast. Is that a trend that we should expect to continue? Well,
the most undersupplied city in the whole of the UK is London for student accommodation. And conversely, London is the strongest city in the world when you look at higher education, and that's by volume of institutions and global quality of those institutions within it. So London as well has been hit hardest by the cooling in the economy, and therefore the land values have dropped the most. And I think that does create a very exciting opportunity for us to potentially deepen our pipeline predominantly in the southeast with hopefully a really good London bias, because I think the balance of risk and reward feels really interesting there.
And that also sits alongside what you're seeing, certainly plenty of coverage in the press as well about university applications. There's the Brexit impact that we may or may not see from to student numbers going forward. Student numbers, whether they will level off. Are there any concerns there about ongoing demand?
No, I think the outlook for UK higher education is really strong and robust. And I think therefore as a market for Watkin Jones to develop student accommodation and forward sell to the institutional demand, that looks similarly robust. I think some of the headlines which are just worth reminding ourselves about is from a global viewpoint, the UK is ranked second in the world for higher education. That's both quality and quantity of institutions. That helps us understand sort of global demand to come and study. And in fact, there's more applications than there are spaces available to come and study within the UK at universities. And it's by a factor of about 20% more applications than there are places available. That gives us a lot of comfort and it insulates us if there is any sort of change in demand going forward. It's a nice backstop position to have there. And I think whilst there has been an emergence of winners and losers within the university sector across the UK, what is really clear is Watkin Jones development pipeline is absolutely focused at providing accommodation for those winning universities and will continue to do so. And on that basis, we see good future growth prospects there.
We flip over then to the interest from the buyers, the institutions. How important is the fresh proposition to that sort of one-stop shop offering that Watkin Jones has?
Yeah, so I do believe that good range of services is increasingly going to be part of the WJ brand, the Watkin Jones brand, which I think institutional investors will increasingly see and value. And what do I mean by that? I think Watkin Jones having a really good comprehensive understanding of the sectors within which it's developing, both student accommodation and build to rent, turning that understanding into a good real estate focused delivery strategy to sort of provide stock into that market. I think that will help reassure institutional investors that when they are working with us, it's from a position of strength, that we have a good insight into the market, which will help complement their own insights in terms of how they want to give rein to their growth strategies. Our track record in securing planning consents, thinking about the configuration, the specification, and actually where you want to locate these buildings in various towns and cities, further builds on that. And then, of course, the construction activity to actually deliver the right quality at the right time for the appropriate cost is something which should never be taken for granted, and it's something Watkin Jones has built its reputation on being able to do year in, year out. And then the final component part of that, coming to your point, fresh, I think for an institutional investor, having therefore forward committed to purchase and make their investment in a student accommodation asset or build to rent asset, to also have the ability to engage us to using our knowledge, acquired knowledge, to then go and manage the asset for them, to go and rent it, to look after the fabric of the building, to really sort of stabilise the asset and crystallise the investment value is a really important component part of that brand. And as I say, I think as the two sectors mature, there are undoubtedly headwinds in both of the sectors which need to be very carefully navigated. I think the institutions and our clients will increasingly value the benefits that we can bring in helping them navigate successfully those headwinds.
It was very much underlining then that it's just as important to BTR build to rent as it is to the student proposition. Obviously at the moment that's a small part of the Watkin Jones profits, but would you see the possibility that it could be larger than student going forward?
No, I do, absolutely. Build to rent in theory is a much larger addressable market than student accommodation. In many respects, build to rent is the parent of student accommodation, and it's just interesting that student accommodation has evolved as a prime asset class in its own right, ahead of the evolution of build to rent. But I think that creates the opportunity. I think student accommodation is the pilot project, big tick, very, very successful over the last 15 years. And now it's time to really focus on build to rent and the evolution of that. And if we look at some of the basic drivers for it, growth in population by 7 million within the UK to 2035. We know that the average household size has been decreasing for the last few decades, and we know that the rate of new supply of housing is woefully inadequate. Now that is leading to a supply-demand crunch. It's already here. It's the preconditions for capital value growth for residential. It's the preconditions for rental growth. But we know that there's a second driver being overlaid on that as well, which is this age of consumerism, which is everywhere in our society and in our economy. And it's firmly coming into the residential sector. And really, people don't want to own they don't necessarily want to own their accommodation, or own their home. They don't necessarily want to have a long lease with all sorts of onerous requirements on them in terms of responsibilities. They want hassle-free living in a managed serviced environment in town centres or edge of town centres where they can live their life and enjoy their lives and potentially also socialise within the buildings within which they operate. Now, that is entirely what build to rent is all about. And we know it's gaining traction. By 2025, the percentage of UK population who will be renting will have gone up from 20% to 25%. And today, 37% of all renters say that they're renting by choice, not because of affordability issues and various things like that in terms of buying. So the whole market is beginning to move firmly into the time for build to rent. There were record transactions last year. £3 billion worth of institutional investment was invested in the build-to-rent sector. That's up from £2.2 billion in 2017, so significant growth in the institutional investor appetite to acquire this stock for those reasons. And then CBRE have recently assessed that there's £33 billion worth of equity from those institutions looking to invest in build-to-rent in the UK over the next 5 years. What does that all mean in terms of values and investment propositions? Well, yields were stable. Net initial yields on build to rent was stable in 2017, both for prime and secondary regional. And there is signs that secondary regional is strengthening in price, and there could well be some yield compression coming through in the early part of 2019. So strong macro tailwinds within the sector. We still need to do those little steps to prove that build to rent is indeed an asset class which is as exciting as student accommodation is today. And we're doing that through the managed pilot programme of our 7 pipeline schemes which we have. And we are seeing successful steps forward with that. So at the moment we have good confidence, but we still want to see a little bit more progression with our pilot projects over the course of 2019 before we really sort of come back and firm up our plans for BTR going forward.
You're speaking to a generation of millennials there who I'm sure would buy into the idea of group living and all facilities on site. But you don't usually find many millennials working at the councils. So when you are dealing with them, getting these projects through, are you finding open doors and a willingness to engage in this new design of living? Yeah,
so councils, I think, are very receptive to this whole flexible living, and they recognise that society is changing and there have been strong societal shifts over the last few years. And as I say, you can see it in all areas of society, not just in how people are living, it's how people are just living their lives full stop. So they get it. The issue is that there is no planning consent or there's no planning policy for build to rent within the UK at the moment. So what you need to do is go through an educational process with each local authority. That takes time for them to really understand how that could benefit residents within their areas. That's a barrier to entry, of course, and it does put off competition. I think for the moment, that is probably a good thing for us at Watkin Jones, because it means that we can, where we are confident to go forward and expanding our build-to-rent pipeline, we will not have as much competition for those sites for build-to-rent. And that gives us the confidence that we could grow and deepen the scale of our pipeline over the short term, if that is what we choose to do. But I do think in time, there will be a build-to-rent use class because of that shift in societal needs and demands. And the government will recognise that and legislate for it. And I think at that time, at the right time, that would be right for the whole sector, because at that stage, suddenly new supply will be much more easy to see coming into the market to provide for that obvious demand. And at that stage, I think there would be an institutional re-rating of this sector, and we'll see much more capital come in, followed by the transparency of how the sector works. I'm sure there'll be various benchmarking of performance and so on and so forth. And I think at that stage, you could see it really evolving into a fully fledged asset class in its own right.
Thank you, Richard.
Thank you very much.
Turning to you then, Phil. If we look at student accommodation, I know if we dig into the numbers there, we did see a couple of percentage drops in the gross margin. Can you explain why that was the case?
Yes, certainly. I think it continues to be the case when we are appraising student accommodation development sites for acquisition that we target a 20% gross margin hurdle. And to some degree it is a reflection of where those assets are that we secure. We can achieve typically strong margins in sites that we're acquiring in London and the South East, which can exceed that 20% hurdle. Regionally, we still target the 20%, but on occasion it may be a little less than that. On a blended basis, 20% is the sort of margin level that we're looking at. I think the margin in FY17 was probably a little higher than that 20% hurdle, reflecting some exceptional margins coming through on some of the schemes that we completed in that year. And in the FY18 year as well, we did announce that we had been successful in the forward sale of a portfolio of 4 assets just before the year end, which will be for delivery over the FY19-20 period. That meant actually into the FY18 period that we did have revenues recognised associated with the land sale elements of those particular schemes. The margin on that will be a little bit less at that sort of stage in the sale, but the margin will flow through in FY19 and 20 on the development works. So overall, we remain very confident in our ability to sustain that gross margin of 20% for student accommodation going forward.
Excellent. Now, obviously, at the moment, BTR is targeting a gross margin of 15%. But there was some comment that you do hope to see that nudge up. Can you give us some idea of how and when?
Yes, certainly. I think the position on build to rent is clearly, as Richard referred to, that market's still very much in its infancy, and we are exercising a degree of caution, I think, in terms of our margin expectations there. I think as that sector continues to grow and develop and stabilise, we do see the opportunity for margin enhancement coming through there. I think partly through a combination of probably appreciation in values that will be payable for build-to-rent schemes, as sort of premium rents are proven on that kind of asset, where tenants will be sort of willing to pay that high level of rent for the quality of services that they're receiving there. And also as the operational efficiency of schemes is proven with our track record in managing student accommodation developments through Fresh Property Group. that's directly transferable to build to rent, and we should be able to drive efficiencies into the operating costs for those assets. All those factors will then ultimately lead to an enhancement in development values, and inevitably as we continue to develop the pipeline there, increasing expertise then in terms of efficiencies will come into play as well. So clear opportunity, I think, within that. I think probably fundamentally the relative density of occupation of build-to-rent schemes is slightly less than in student accommodation, just by virtue of the numbers involved. So you will probably expect, generally speaking, that student accommodation would tend to still show a higher margin than build-to-rent, but there's clearly opportunity to progress that.
Okay, I won't pin you down to a number just yet. But if I think back 6 months ago, there were discussions about introducing potentially a build-to-rent fund that you could sell your assets into. Could you give us some sense of where the board's thinking has got to on that one?
Yes, I think the build-to-rent investment vehicle is an opportunity which the board is very much still considering. As a board, we are hugely excited about the build-to-rent opportunity generally. From Watkin Jones' perspective, the important thing is that we forward sell the build-to-rent development assets in just the same way that we do student accommodation. The attraction of potentially setting up an investment vehicle is that, which would be independent from Watkin Jones, is that it would help, I think, in some ways to smooth that delivery process of build-to-rent assets from a forward sale perspective. Effectively, such a vehicle would almost be a dedicated client to Watkin Jones, which would mean that each development being forward sold into it will be on quite a repeat basis. So the process of going through separate negotiation of contracts and development agreements and so on would not be the case, and you'd have a much smoother process. So potentially accelerating the build-to-rent delivery process for us. It also has the benefit that potentially we can bring in some additional revenue streams to Watkin Jones associated with that investment vehicle, potentially through fund management fees, for example, and also Fresh Property Group would be the nominated asset manager for those, so it would bring in that accommodation management revenue as well. So some positive additions to that. For where we are at the moment, we're continuing to evaluate the opportunity. We intend to potentially talk to potential investors in due course, and we'll update our shareholders once we have a clearer view as to whether that is the right decision for the group at this point in time.
Is there a risk that you would alienate and come into conflict with existing institutional investors, or do you see them as being the eventual owners of the fund?
Clearly that there is the potential there for institutions who are obviously very active, keen on the build-to-rent opportunity to be investors in that sort of vehicle, so that's certainly an option. I don't think at this point in time our view is that it wouldn't conflict with our institutional client base. Clearly with the student accommodation we have a broad established client base for student accommodation. Many of those institutions are the same, that are clearly very interested in the build-to-rent space, but for where we are at the moment, we're not directly supplying to those. So I don't think there will be direct competition there. However, I think also the agreements that we entered into in FY18 for the 315 apartment scheme in Reading, which was for M&G, and in Wembley, a 300 apartment scheme for Singaporean investors there, I think demonstrate actually very clearly Watkin Jones' reputation as a developer of multi-occupancy residential assets, and the transferability of the skills from the development of student accommodation into build-to-rent. So alongside developing our own sites for build-to-rent, I think we now see an opportunity as well there to partner with the significant institutions in build-to-rent to act in a development capacity for them as well. So we can really sort of progress the build-to-rent opportunity in two fronts.
Okay. Let's touch then on Fresh, which is becoming an increasingly attractive part of the business, 60% gross margins and growing well. In terms of the client base there, what's the split between those managed beds that have come from Watkin Jones and come from outside Watkin Jones and split between student and BTR, and where are the growth drivers coming from?
Yeah, I think for Fresh Property Group, which trades under two brand names. So we have Fresh Student Living, which is the manager for student accommodation, and 5-9 Living, which is the brand that we've set up to manage build-to-rent assets. The reputation of Fresh Property Group has really continued to strengthen over the recent years. It's recognised as a significant partner to the institutional clients that we operate for. And that reputation has really enabled Fresh to capitalise on the broader opportunity in the management market there, and has been increasingly successful in winning opportunities for schemes for management that haven't been developed by Watkin Jones. So as of today, Fresh currently manages about 52% of the assets under management are non-Watkin Jones developed schemes, which I think really demonstrates that success Fresh has had in winning those opportunities there. And underlying growth in Fresh has been excellent. So it was appointed as manager for 14 new schemes in FY18, about 3,700 beds. And if you look forward, already for FY21, Fresh is contracted to manage just over 19,000 beds and built-to-rent apartments at this point in time. So continuing good growth in the Fresh position there, and we remain very optimistic about the potential to continue to scale up that operation.
Fantastic. Well, let's finish a couple of comments on the dividend, which saw a nice jump up. What is the planned progression for the dividend going forward?
Yeah, so delighted to be able to have announced an increase in the dividend for the year to a full year dividend of 7.6 pence, which is a final dividend of 5.13 pence per share, about a 15% increase on the prior year dividend. 12 months ago, the board had announced that we would move to a formal dividend policy of 2 times covered on a adjusted earnings basis. For the current year, the dividend cover is at 2.1 times, so that means there's still room for some progression in that dividend growth into FY19. So yeah, I think we're in a staging position at the moment, and hopefully able to progress that dividend in FY19 as well.
Well, thank you, Phil, and congratulations again on a fantastic set of numbers.
Thank you, Hannah.